Hi students, this is Mr. Jason. So previously we have covered two categories of ratios, liquidity and stability ratios. Now in the profitability ratios, which can be found in page 276 of the textbook, there are three different ratios that can be used to measure profitability. And I think the term profitability itself is quite straightforward. It basically measures how profitable a business is. So the three ratios are profit margin ratio, sometimes it is called profit ratio, rate of return on assets, and also times interest earned. Now, the first ratio called profit margin, it shows the percentage of profit after income tax that is contained in each dollar of sales, right? So the formula is given here. It is similar to the formula in your specifications booklet. So it is profit after income tax divided by total revenue times with 100. Now, it is important to note that total revenue here may be in the form of sales, net sales, or fees, if it is a service business. If it is net sales, it means sales minus sales returns minus discount allowed. It's very important to note that because sometimes questions can actually break down these three categories. So you need to minus all of them first before you can find the total revenue. Now, an example here given is an income statement. So if you are required to calculate the profit margin ratio, then what you can do is you take the profit after tax. It must be after tax. Do not take the before tax amount, and then divide it by the total revenue. In this case, it is the sales, right? You don't have sales returns or discount allowed, so it is fine to just take sales. Times with 100, you get 9.4%. This means that for every $1 of sales made, then you would have 9.4 cents as profit after tax. Now, you will not really know what is the right figure for the profit margin ratio to have for any company, but you would want it to be higher. You would want it to increase compared to previous years or compared to an industry average or even a company in the same industry. But how do we look at the interpretation a little bit more closely? So you can look at reasons why profit margin ratio can go up. It may be caused by reduction in expenses. When you manage to control expenses very well, then you will have more profit after tax, which means a higher profit margin ratio. An increase in selling price, and which is greater than the increase in the cost of sales. This also means that the total revenue would actually be higher, which reflects in your profit after tax. Or you can actually manage to find a cheaper supplier or inventory, which results in a higher profit after tax. If it is decreased, then the opposite is true. It may be due to an increase in expenses, increased competition, which cause you to lower your selling price. So these are some of the generic reasons why your profit margin ratio can go up or down. Now, the second ratio for profitability is the rate of return on assets. So this measures how efficiently a business has used its assets to generate profit. Now, the formula is given here. So the formula is profit before tax plus with interest expense divided by average total assets times with 100. So it is slightly different from the first formula. So you use the before tax for profit and then you add with the interest expense. Now, what is average total assets? How do we calculate that? Let's look at an example in the next page. So you can see that they gave you the income statement, but they also gave you the assets for two different periods. One is at the end of 2017, 30th June. One is at the end of 2018, 30th June. So how do you calculate the average? It's easy. You just need to take the two amounts here. So this would become like the opening asset. This would be the closing asset. So you add both and then you divide by 2. So the average asset for that year is this much. And when you want to find out the rate of return on assets, it's easy. So it's just the profit before tax plus with interest expense divided by the average total assets. You times with 100, you get 16.4%. You need to compare this to previous years, to an industry average, basically any comparison means. But you generally want it to be higher, because that means that you are more efficiently using your assets to generate revenue. Now, let's go to the third ratio. For times interest earned ratio, this is basically reflecting the number of times that the interest of the company is covered by profit before tax. So you do want the interest earned to be higher, right, than anything you compare it with. So the formula here is profit before tax plus interest expense and then divided by interest expense. You don't have to times it with 100 this time because the answer, the unit of the answer is in times, not percentage. So let's look at an example here. You have the income statement. So when you want to find the times interest earned, you take the profit before tax, you plus with the interest expense. This is the interest expense. You divide it by the interest expense again. So you're going to get something like 5.87 times. This is what I mean. The unit here is times. This means that your profit before tax plus with the interest expense can sufficiently cover the interest for more than 5 times for that year. Now, how do we interpret this ratio? So generally speaking, when we look at a widely held view, the times interest earned ratio of between 3 to 4 times is a good safety margin. Of course, you want it to be higher because it means the business is more profitable, and lower would mean that the business is not so good in terms of profit.